Welcome, everybody.
Hey, how you doing?
I'm good. I'm good. I can't believe it's October, but I'm good. So today should be a fairly quick, self-explanatory presentation. We'll wait a few more minutes to let everybody jump in, but I estimate it'll be about 15 minutes today. Unless you guys have really good questions, then it may go long.
Okay, here we go.
Okay. So happy October. We're going to go through all the same topics that we always do: the market, treasuries, the economy, the Fed, alternate investments, and then a little synopsis of the takeaways. Same takeaways we've had with a little more time in between to kind of uh, see how they're filtering out. So the market continues to go up. This is a 1 month chart. S&P's up 3.37% just over the last month. I do think that's going to stop at some point. We'll see. So, treasuries, the yields have pretty much stayed the same since last month. I think the end of this month is when the Fed is meeting, and we should see another cut. The government shutdown obviously is the big discussion right now. How is that going to affect the Fed and their decisions? And I don't think it will. It shouldn't. The macro results that we're going to see from the shutdown is there will be government jobs that are cut. So that will hurt the economy a little bit, but it will help the government in shrinking and having more money to go towards entitlements and programs that frankly need to continue. I think it's a bit of well, let me put it this way. I think we'll see the end of this by the end of this week. I think the Dems will find it difficult to continue beyond this week. So, to give you an idea, one of the things the US has 37 trillion in debt, and what this shutdown is over is keeping the current budget versus adding a bunch of items to the budget. So the Dems want to add 1.5 trillion to the budget, whether it's important things or not, which it's debatable whether it is. That's another 1.5 million that would need to be borrowed. There is no revenue to cover that. So with the government getting shut down, we have employees currently who are not getting paid for work they've already done. And that kind of gives you an idea of how much money and cash flow the government has when things get shut down. So, in my opinion, there shouldn't be any new expenses until we cut something else. And I don't see a need for any new expenses. Those funds should just be allocated properly. So, I as I said, I don't think it's going to have a major effect on the economy. I don't think it's going to have a major effect on the Fed. So, next screen. So the next meeting is 28th, 29th, and it is expected that they'll cut another quarter point. That only helps our situation as far as the bonds. That should drive the market value of those bonds up. So we should continue to see that again through the end of the year. Fedometer is steady, showing that there's a high likelihood of a cut. Obviously, if it gets all the way down to the more conservative, then we'd see a chance at a higher cut potentially, more than a quarter point. Okay. Schiller PE ratio, don't know, probably nobody remembers this but me. Last month we were at 39.06 or something like that. So we're 1.2 points higher today than we were a month ago. And if you remember, historically, the PE ratio should be between about 16 and 20. So we're double that normal range currently, which is in the past has meant a significant drop in the market. All three times it got above 25 PE in the past, which is 1929, 2000, and 2008. Every one of those times we've had a 50% drop or more. And so, again, we've talked about this. I don't know that we'll have a 50% drop, but I would not be surprised with all the influx of cash and things that are happening into the US if we see maybe a 25 to 35% drop in the market. So that will be a great opportunity to reshuffle how we're allocated at this point. So inflation up to 2.3%. Government had it at 2.9%, but you'll see it's becoming very range bound, peaking at around the 2.35% range, and then it comes down and then it goes back up there. So it's kind of creating a range that it looks like it's going to stick in, which, by the way, that's normal inflation. So we're at a normal historical inflation rate right now. The gold index just continues to go up. We broke 4,000 recently. So one of the things I read recently is a lot of foreign governments are buying up gold. And so we should see that continue to rise. I wouldn't be surprised if we see 5,000 an ounce by the end of next year. All of that depends on U.S. economy and inflation and all of those things. But I, again, would not be surprised if we saw that moving forward. Okay. Silver, same kind of situation. You'll see a much steeper incline in the second half of this chart. It was more flat at the beginning, but now it's kind of caught up with gold with the amount it's grown. Again, I wouldn't be surprised to see this one at 50 before the end of the year and maybe even 60 next year. So plugging along there. Okay, so here's our synopsis and all the things that we've been looking at throughout the year. Again, the tariffs have been, for lack of a better term, a nothing burger at this point. They have not created out of control inflation. They have not stopped products from coming into the US. In fact, the consumer is very happy. There is a significant amount of income that is being generated from those tariffs. In fact, Trump came out and said there may be a refund going to taxpayers by the end of the year of $1,000 to $2,000 per taxpayer. You may remember early in the year, we talked about a Doge dividend and how that would be a return of tax dollars. So this is another way they're looking at doing that to keep the consumer strong and keep the economy moving. Tax cuts, the big beautiful bill had very significant tax cuts for all levels of income. So we're actually seeing wages increase for the first time in a long time versus inflation. Deregulation. Other than California, it seems like deregulation is happening quite a bit. Projects that might take a year to get started are now 3 months or so. So we're seeing things move much more quickly in this iteration of the government. Reduction of wasteful spending. Frankly, the shutdown is helping with that because with the government shut down, a lot of the oversight for government layoffs and whatnot falls directly to the executive branch. So they're cutting where they saw waste before. Now they have a more justified reason to cut some of those jobs. And then finally, interest rates and Fed policy. Interest rates are starting to come down. Last month we had a cut, likely to have a cut this month. All of those things together give a very positive outlook for the economy 2, 3, 4 years down the road. Likely we're going to have a slowdown in the economy at some point, I would guess over the next 12 months, but it should be fairly short-lived. It should coincide with the stock market coming down. But I do believe with the infusion of outside capital from other countries and companies coming back, manufacturing coming back, all of those things, I do see a very quick recovery and the economy coming back much stronger. Any questions? Okay. Give you the disclosures.